Hey everyone, welcome to Alpha Insights. I'm Daniel Snyder from Seeking Alpha. We just want to go ahead and continue this amazing series that we have going on about the macroeconomics and specific industries within the stock market to help you as investors know how to analyze what's going on right now and what to do going forward. There's a lot of crazy stuff going on in the world, from supply chain disruptions to new EV and meta and space and so much more. So we just have a couple of our great marketplace authors from Seeking Alpha joining us today. First off, we have Jay Mintzmeyer from Value Investors Edge. We have Eric Basmajian from EPV Macro Research and Brad Thomas from iRead on Alpha. How are you gentlemen doing today?
Great.
Doing well, Daniel. Thanks for the invite.
So I just want to kick this off. Let's look at a quick recap of what's going on in the markets. The Dow Jones is up 18% year to date. The S&P is up 24% year to date. NASDAQ up 23%. Bitcoin up 119%. And Ethereum is up 518%. Now, that's all great. But also, the 10-year yield is now ripping higher and faster because of all the news and the data that we're getting in the market nowadays. But let's start with supply chain. The supply chain has been backed up, but is it now starting to ease up a little bit? Jay, I would love you to help just jump in here real quick. Tell us what you're seeing with the dry bulk index, analyze what's going on right now, and what are we to anticipate going forward from here?
Yeah, absolutely, Daniel. Thanks for the invite here. Absolutely a pertinent topic. I do want to split these up a little bit. Dry bulk index is mostly iron, coal flows, things like that. That mainly has to do with China. Whereas the supply chain crisis, as most Americans or Europeans as well tend to think about it, has to do with container ships. So real quick on each. With dry bulk, we're really getting driven down lower by poor iron ore trade levels. Coal's also a little weaker than we anticipated. China is doing a lot of things there. There's a lot of new data that came out actually just yesterday morning showing that iron ore imports are down due to lower steel production levels. Cement is also way down. That's partially related to the Evergrande issue with property developers slowing down. It's also a little bit related to China focusing on their energy crisis. They're prioritizing everything for coal imports, focusing on domestic coal production as well to make sure that the power plants have enough materials. So dry bulk's been really weak and choppy the last month, but we expect it to maintain choppy and a little bit downward. Seasonality is going to kick in. It's always weaker at this point. Pivoting to the supply chain with container ships, the popular narrative has been that the supply chain is easing and improving. But if you actually dive into the data, look at the numbers, that's not really what's happening. If you look at LA and Long Beach, for instance, and you look at the levels of congestion and the ships that are waiting at dock or at anchor, we're at all-time record highs as of earlier this week. There was a 60-minute special out just 2 days ago, which is putting this on a lot of folks' minds. But we haven't seen a movement in the stocks. In fact, the stocks have been more so sideways. So we're looking forward to the rest of the week and seeing what the market will give us.
Yeah, so you said there's more ships than ever sitting off the coast. When is this going to start to ease? Because obviously we're going into the holiday season. You're talking about the seasonality. When does this end?
So normally we see a peak of the ships off coast around mid-October to early November. That happens every single year. Of course, normally we're talking 20 ships, not 70 or 80. So that's the big difference here. For shipments leaving China now, you're already too late to make the holidays. In fact, for even some of the ships out in the water off of California, if they're shipping Midland to the Midwest from there, those products might still not make it to the shelves in time for the holiday season. So a lot of uncertainty there. We do expect that those ship queues are going to start to reduce as we get through to the normal seasonal lull, which is post-holidays. So think January, February. There's also a slowdown every year in China related to the Chinese New Year, Lunar New Year. There's also probably going to be a little bit of a slowdown in China due to the Olympics. They're trying to clean up their air. So that means they're probably going to idle a lot of their industries and factories for at least a few weeks before the Olympics. So we expect a slowdown in supply push out of China around January, February. We expect a slowdown in imports in the United States around January, February. Hopefully, that'll give the ports time to catch up. Because if they don't catch up in January and February, then we're going to be right back into it next summer.
That's a really great point. Now, Eric, I want to bring you into this because obviously we've been talking about how the supply chain is disrupted. And obviously this is leading to the higher than normal inflation number that we just got. I mean, the reading was, 0.9%. So it's up 6.2% year over year over the last 12 months. So is this inflation, if Jay's saying that the supply chain is going to ease up, is that going to help our inflation story kind of calm down a little bit?
Yeah, thanks, Daniel. And I'm glad Jay went ahead of me because he's really the pro on the supply chains. But when you look at the inflation numbers, if you measure it on a shorter term basis, like a 6-month annualized growth rate, the inflation number was actually 7.1%, which was the highest level we've seen in over 40 years. So these are absolutely earth-shattering numbers in terms of the rate of inflation, but I want to break it down into 3 buckets. Rent inflation, which everyone's very focused on, commodities and energy, and then durable goods. Rent inflation is a big component of the basket. It's upwards of 30%, and that's going to continue to trend higher as we move through 2022 based on the historical lead of home prices. So we know with pretty high degree of certainty that we're going to see rent inflation continue to trickle higher as we move through next year. Energy inflation, however, we've seen a plateau of the main commodities like oil prices. And in the way that inflation's measured, since we're looking at price increases, unless we see the price of oil rise over $100 a barrel, as we move into next year, we're going to see a rate of change decline in the inflation contribution from energy. So there's going to be a little bit of an offset there. Where the inflation story really is going to have the test is durable goods. Durable goods is a smaller portion of the basket. It's only about 10%, but the volatility of the durable goods basket is driving the whole index. And what I mean by that is durable goods was in persistent deflation prior to COVID. Every month we had readings of -1%, -2% on durable goods that exploded to 20% annualized. So at a 10% weighting, that durable goods basket is adding over 200 basis points, almost 250 basis points to the overall CPI reading. And the reason is because we pulled forward so much durable goods consumption through stimulus, lockdowns, putting people at home, and people moving from cities to suburbs, having to furnish their homes with durable goods. We pulled forward, by my calculation, 7.5 years worth of goods consumption in about a year. So that is going to take some time to work off. And Jay really is the expert on the supply chain. But I wanted to break down those 3 baskets because there are some factors that are going to roll off next year unless we see a doubling of energy prices again. But the real swing factor is going to be durable goods, which is going to be completely correlated to these supply chain issues. So if we see the supply chain issues linger, then inflation is going to linger at these high levels as we move into next year. If those issues clear and the durable goods are able to come through and pass through the consumers, then we'll see that the inflation rate is going to come down quite a bit as we move into next year.
Yeah, Eric, I got to say 7.5 years. I mean, that's so far in the future. Now we're talking about how this might linger, this might not linger. And I think this is a good time to introduce, we're starting to get some new calls for next year from Morgan Stanley saying the S&P is going to be down at 4,400, which is lower than where it is now, which should be concerning for most people, right? But then you also got Goldman's David Kostin saying we're heading higher to 5,100. Wells Fargo just put out there, says raises their forecast to 5,100 to 5,300. So it almost sounds like they're trying to figure out, is this growth in the earnings or is this valuation with the inflation? And is this easing? Is this not easing? Does anybody actually know where we're going to go? It seems like, because for investors, we need to try to figure that out.
Right. Yeah. The estimates are all over the map because so much of the economic data has been, I don't want to say distorted, but there's a element of volatility that's been introduced to all of economic data based on when stimulus payments hit people's accounts, when supply chain issues get cleared. For example, today's industrial production numbers were better than expected. Last month was worse than expected, but the swing factor is just the fits and starts of the auto sector, which it has to do with when they're able to get parts and not. So I think a lot of people are still confused with what's going on here. If we look at the secular trends, we're still going to be battling tougher conditions going forward. And I think where most of the downside estimates are coming from is the fact that we're moving into an environment where the Federal Reserve is going to be trying to remove accommodation. And the marketplace is sort of starting to pick up on that. And we can see that as evident by a really strong US dollar over the last couple of months relative to the other major foreign currencies.
Yeah, and the dollar is hitting highs that we haven't seen since July 2020, which I think people should also keep an eye on.
Which counterbalances some of the popular inflation narratives that we were seeing. Remember, just a couple of months ago, we were back again seeing the headlines of the death of the US dollar. Is the dollar going to lose its reserve currency status? You know, all of those stories tend to circulate every time when we're doing quantitative easing, but then the dollar shows its resilience, particularly against the other major currencies. So I think that is a story to keep watch. And I would pay particularly close attention to the US dollar. Really persistent strength in the US dollar against the more cyclical currencies like the Australian dollar, the Canadian dollar, tends to lead periods of slower economic growth. So if the dollar continues to strengthen and the Federal Reserve continues their path of tightening monetary policy, that would be a time where investors may want to consider being a little bit more cautious than they normally are.
Yeah. And actually, you set this up perfectly. I couldn't have done it better myself. Brad, he introduced the idea of talking of tapering with the strong dollar. Are we going to see an accelerated growth? I mean, if we do, how would this affect the real estate industry if we start seeing the potential of a faster taper and maybe interest rates starting to rise faster?
Yeah, and by the way, you had some great panelists before me. So, but yeah, let me first say we've been through taper tantrum before. This is taper tantrum 2.0, but now we've got taper tantrum. We're still coming out of a pandemic. We've got the labor supply. So there's a lot of other factors that really go into this overall mix. Now, of course, we're talking real estate. And brick and mortar, primarily, or equity REITs, not mortgage REITs. So first and foremost, most of the equity REITs in our coverage spectrum have significantly delevered their balance sheet. They've prepared for this inevitable taper tantrum 2.0, if you will. And so, you've got much healthier REITs today overall. We've seen quite a few investment grade upgrades over the last several years and even recently. And so these REITs have locked in, their cost of capital to match fund their lease obligations. So then let's talk about lease terms, because this is, I think, one of the most interesting dynamics I've seen it really in my real estate career, because I've never lived through a pandemic. I've lived through multiple recessions, and I was a developer in quite a few recessions, including the last one we call the Great One. But what's interesting now is we've got this almost bifurcation of leases. So we've got the longer duration leases, which of course are net lease REITs and healthcare REITs predominantly. You could also lump in data center REITs and cell tower REITs. So these are your longer duration leases. And then we have everybody else, which is either the monthly, the daily lease, which is the hotel, the monthly lease, self-storage, or multifamily. So we've got these really two baskets of property sectors, if you will. And so what we've seen is the institutions primarily have really gravitated to some of these shorter term leases. So that's why we're seeing sectors like apartments and self-storage primarily have really valuations have just gotten incredibly frothy. Then you look at the other side of the basket, and you have the net lease REITs. Predominantly the net lease REITs. The gaming REITs would also be included in that. Cell towers, data centers, and those are the companies that have really underperformed year to date because of their really lease, the fear over rising rates and the fact that at least the market perceives that some of these companies will not be able to adjust for inflation. Now, we write about this a lot, we talk about this a lot, and frankly, we invest in a lot of these companies. We don't follow the herd, the institutional investors, and so we think there's a lot of value today in some of those sectors that have really not performed as well, because we do believe that they can adjust for inflation. Some of these leases have CPI structures built into their leases. We also look very closely at these payout ratios to make sure that there's adequate cushion or capacity for these companies to increase the dividend during those times. So again, kind of looking at the whole sector in general, it's really important to look at these balance sheets, make sure they can handle the inflationary environments, and so that's where we've really positioned ourselves, as it relates to the entire REIT coverage spectrum.
Yeah, so it sounds like you're just saying that, of course, like all stocks, there's the really great companies with the great management and the not so great with the bad management. And within the real estate sector specifically, I think a lot of people, and correct me if I'm wrong, had the opportunity last night, like the malls or the data centers or whoever, to restructure their companies and really come out on top at the end of this, correct?
Yeah, no, that's true. And again, I talk about this a lot. I mean, there's really two primary advantages we call, moats, competitive advantages. And we see this not only in real estate, but the other sectors, and I'm sure in shipping as well. But we look at the scale advantage, we look at the cost of capital advantage, and they're certainly correlated. And so what we're seeing is these dominant players now are really appearing. Companies like Simon Properties, for example, which company does have the fortress A-rated balance sheet, the scale advantage, the cost of capital advantage, and you're going to see, the bigger get bigger. And, these other ones are really going to be getting squeezed out more. So we really like to focus on those companies that have those advantages, that are the dominant players, like Digital Realty, for example, in the data center space, or for example, American Tower, which, by the way, announced yesterday, pretty interesting news, that they are making a run to acquire a data center REIT, which was somewhat of a surprise. But again, you're seeing that the companies with the scale advantage and that cost of capital advantage continue to grow and consolidate. So it's really exciting time to be a REIT investor.
Yeah. And I think also going forward, REITs aren't done yet. Now, the interesting thing is we don't have any REITs for anything in space. And that's where we're going to go about next. Last week, we had Chris Demuth Jr. talk about SPACs. Well, this week, we're going to add an E on that and talk about space. Today, we have joining us Cody Willard from Seeking Alpha Marketplace Service, Trading with Cody. Go ahead and bring him on into the conversation. Cody, how are you doing? You there with us? Let's make sure we got your mic.
I muted it. Yes,
there
I'm here.
Go.
Thanks for having me. That was a great segue over from SPAC to space. And frankly, there's been a lot of space SPACs, so it's blended anyway.
Exactly. I wanted to bring you in because we had, of course, everybody saw that William Shatner went to space. And a lot of people don't know maybe that Tom Hanks was first offered the seat on Blue Origin's space shuttle ride up to space for $28 million, first off, which, I guess Bezos, when it comes to that, at the end of the day, there's no free rides. But Blue Origin also announced that they're going to be working on a commercial space station. Wanted to see if you could just give our viewers some information and some expertise, and maybe even some companies or stocks that they should be looking out for in that sector as this goes forward.
So yeah, let me even just back up a little bit and explain why I'm so excited about space itself. What I'm always trying to do is find the next multi-trillion-dollar economy that's going to be created. And I've done it in apps with smartphones. I've done it with cryptos and Bitcoin. And we did it with electric vehicles on Seeking Alpha, on Trading with Cody's service that we wrote all about at the time. And I think at this moment, the clearest, most obvious next multi-trillion-dollar platform that is going to be built upon is space itself. People are talking, and you're asking about like space tourism, and that is certainly a big element in it. But the costs of getting people and satellites and computers and factories and hotels up into space are basically approaching zero. The cost is going to zero. It's getting basically free incrementally compared to what you're spending to do in space. So what I like to tell people is like maybe in 10 years, going to that space hotel in orbit around Earth will be comparable in cost to going to Disney World. It's probably going to be 3 or 4 times as much, but it's going to be at least in the same universe, so to speak. Boy, there's so many puns you can use with space. And so look, I'm all over the space revolution itself. And the fact of the matter is that most good space companies are still private. SpaceX is by far the best space company out there. Blue Origin is a great space company. It's Elon would tell Jeff Bezos it's number 2 though. And my favorite publicly traded company by far is Rocket Lab, RKLB. They actually reported earnings yesterday. The company has just turned, positive gross margins. It's just starting to turn profitable, but the space industry is so new. There are only maybe 3 dozen worth of publicly traded space stocks. Most of them, like Iridium, have been around for years, and that's not very exciting. I think their cost structure is actually it's going to be in trouble for them because that used to take hundreds of millions of dollars just to get your satellite up to space, and your satellite used to cost hundreds of millions of dollars to build. And now you've got companies like Black Sky, BKSY is another one, Spire is another one. These companies are basically sending computer servers with solar panels up into space. And the technologies, again, are getting cheaper and cheaper and cheaper. And the way to get up there is ever cheaper and cheaper and cheaper. Technologies are getting better and better and better. It's a very exciting place to be investing. But by the way, we are 5 years probably too early before, in 5 years, there will be 50 great space companies that we can invest in. Right now, there might be one or two.
Yeah, no, that's a great point. And I know they mentioned Redwire and Genesis Engineering, I believe, that are going to be working with Blue Origin on this commercial space station. In your opinion, I mean, is this prime time to start investing in these companies?
It is, but you've got to understand that, look, there's been maybe 10 space companies that have de-SPAC'd or are about to come public through a SPAC, either one. And Redwire that you just mentioned is one of them. I own a little bit of The three that I own that are publicly traded. I own SpaceX in my hedge fund, and I've owned it for a long time in the private markets. But and I own several others that are in the private markets that are very exciting that will be coming public soon. But in the public markets, Rocket Lab is my favorite, RKLB. Redwire is probably number 2. Black Sky is a distant number 3. And then I don't really like very many other space stocks that are out there right now. But I am spending all of my time, money, and energy working on space, including creating a space crypto called Skittles. It's actually on seekingalpha.com. If you look me up, I have a free article with links to Skittles.com, which is a crypto for space. We're going to try to clean up space debris through our cryptocurrency, through rewarding it and everything. And so look, the space is very exciting. It is the time and place to be investing in it. Everything else I think is frankly boring. I was in smartphones for 15 years before now, right? Apple's I've owned since 2003. Google's been one of my biggest positions since it came public. That stuff's boring now. You want to look for the next revolution, but you do have to understand probably half of the space companies that are public right now are going to zero at some point in the next 5 years. Half of them are going to go up 5 or 10 or 100-fold. And then there are going to be dozens or hundreds more that we're going to get to invest in 3, 4, 5 years from now.
Yeah. Well, you heard it here first, folks. A lot of these companies might go to zero. We'll see. Cody, thank you so much for your insight today. I really appreciate it. You take care, all right?
Hey, thanks for having me.
Yep. All right, so I got to go back to you, Brad. Obviously, no REITs for space yet. No space hotels, no space homes, no space malls. But we currently have REITs like VC Properties, VICI, right? We're talking about Las Vegas, casinos, things like that. What are your thoughts on that kind of space right now?
Well, I just got back from Vegas. So I've gone on a world tour. I've been to Paris. I've been to Barcelona. I've been to Las Vegas and Chicago and West Palm Beach last week. So, we're looking at a lot of real estate. And I was in Vegas specifically to look at some of the new properties that VICI is now going to own, specifically the MGM Growth Portfolio. That's MGP. So MGM created a REIT utilizing the MGM assets, much like VICI really launched via the Caesars assets, which Caesars was in bankruptcy and then spun into this REIT called VICI. And so we see a lot of opportunity for the gaming sector. But what's really interesting is it's not just really about gaming. You see companies like VICI who are really getting into the experiential business. Now, what's interesting, if you would have asked anyone last year, 2020, about experiential, nobody wanted to own anything experiential in 2020. We're all sitting at our home trying to figure out, when we're going to go back to our real offices and travel around. So now experiential is like the hot, sexy thing that everybody wants. And so VICI is not only investing in gaming, which is proven to be a pandemic-proof business model. The VICI collected 100% of rent in 2020. But also now expanding into other experiential property sectors. So there's a company called Great Wolf, which is basically an amusement park that now is funded with private equity money. And VICI is the landlord of those properties, or at least will continue to be the landlord. They also have invested in these Top Golf clones or lookalikes There's a company called Big Shot Golf, which looks just like a Topgolf. It's also private equity backed. And again, Vici is the landlord there. So we're really looking at Vici's growth. We think that's going to be a tremendous business, especially with the MGM merger, which should close in the first quarter of 2022, as well as the Venetian, which is a huge property, one of the largest hotel conference centers in the world. Vici's also buying that. So we definitely see Vici growing. We think right now it deserves a higher multiple today than any of these gaming REITs due to the quality of the properties. These are very large trophy assets that they're acquiring. So we think there's room for the company to grow not only through a multiple expansion, but also through the growth, the significant growth, which we think is probably in the low double-digit range in terms of their earnings profile. So definitely a strong buy for Vici. We really like that company and, again, that business model.
Yeah, that's fantastic. Eric, I got to ask you, with interest rates and everything that you follow from a macro standpoint, I mean, obviously, real estate in the past has been a pretty good hedge against inflation. Is this a sector that investors going forward should continue to look at and continue to invest in at this time?
Well, I always approach the world with a balanced portfolio that takes in various asset classes, so including stocks, commodities, gold, treasury bonds. From the way that I look at the world, and Brad is obviously the absolute expert on the real estate space, when the real estate space is extremely broad, there are some components of real estate that are extremely sensitive to economic conditions. Hotels, for example, would be more sensitive to changing economic conditions. And then you have some of your longer duration REITs that have more stable cash flows. For me, from my perspective in economic conditions, as the growth rate in the economy continues to slow, I would be positioning more towards the defensive equity sectors, including defensive equity REITs. When we talk about interest rates are moving pretty swiftly across the curve. 2-year rates are jumping, 5-year rates are jumping, even 10-year rates are jumping. 10-year rates are still below where they were in March of 2021, and 30-year rates are 50 basis points below where they were in March of 2021. So we're not seeing screaming interest rates across the entire curve. We're seeing interest rates that are jumping that are much more tethered to the ones that the Fed controls, which is in the front end of the curve, where the back end of the curve is still remaining persistently low, which is giving investors a warning sign. So for me, from my vantage point, if you are looking in the real estate space, I would look towards more of the defensive sectors.
Gotcha. All right, guys, this has been a great episode this week. I appreciate all of you for joining us. Let's go around real quick. Everybody share one investable idea for our audience, if you don't mind. Eric, you're up first.
I would look at the U.S. dollar. I would stay long U.S. dollars.
Brad?
First I got to say, you never can buy just one company. You have to diversify, right? That's the disclaimer. But and I'm not going to say Realty Income. I know everybody's expecting me to say Realty Income, but let's go with Postal. We just covered them on Seeking Alpha yesterday. This is a pure play post office REIT. We think the post office is going to continue for a while. I just sent my Christmas cards out in the mail. And so let's go with Postal REIT.
Jay, bring us home.
All right. With the supply chain issues, we're still looking at Zim Integrated, ZIM. We're long that stock, myself and many of our members on Value Investors Edge. They're actually going to report earnings this Wednesday, November 17th in the morning. We're expecting a resounding earnings beat. So hopefully when we watch this video later, we'll be looking smart.
Yep. All right. Well, that'll do it this week for Alpha Insights. Thank you for tuning in, and we'll see you next time.